Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. Thank you so much for joining. If you have questions or topics that you wish to discuss, please chat those over. We'll dive right into the ultimate mega backdoor Roth, how to save up to $140,000 in two 401k plans. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So let's get started with some basics. Number one, solo 401k eligibility. So a solo 401k plan is a 401k plan for a self-employed person. So in other words, for an owner-only business with no full-time W-2 employees. Think like an independent contractor, could be a solo practicing professional like a CPA or an attorney or medical professional. The key is that you're reporting earned self-employment income with no full-time, non-owner, non-spouse W-2 employees working for any business owned by you or a spouse, if any. You do not need to have a formal legal entity to be eligible to set up a solo 401k. For example, we have many individuals who operate as a sole proprietor. Or of course, you could have an LLC or an S Corp for your business. Ultimately, the key is that you report earned self-employment income on your taxes. So for example, income reported on Schedule C of your 1040, or income reported on a W-2 in the case of a business taxed as an S Corp or a C Corp, or income reported on K-1 in the case of a self-employed business taxed as a partnership. There's no minimum amount of earned self-employment income that one needs to be eligible to set up a solo 401k, but of course your ability to contribute to the plan will be a function of your earned self-employment income because you can't save more than you earn. A spouse or business partner may also participate as long as your spouse or business partner is also reporting their own earned self-employment income, such as their own Schedule C or their own W-2 in the case of a business taxed as an S Corp or a C Corp. Now, it's also possible to set up a solo 401k even if you have a W-2 job, a day job, even if you participate in your W-2 employer-sponsored plan. And that's exactly how one would be able to take advantage of the ultimate mega backdoor Roth, how to save up to $140,000 in two 401k plans. So we're talking about a situation where someone has a day job, participates in their 401k at their day job, and then is also self-employed and therefore eligible to set up a solo 401k. So the way that it would work, again, is that the individual has a 401k plan at their day job, right? They could be working at a big corporation. For example, Amazon has a 401k plan that allows for voluntary after-tax contributions and then in-service conversions to a Roth account. So your day job plan would have to allow for mega backdoor Roth contributions. Specifically, when you make a mega backdoor Roth contribution, one is making a voluntary after-tax contribution. So you'd have to make those voluntary after-tax contributions to your day job plan and then convert the money. Thank you so much for the question. We'll turn to that in a moment. Convert the money from the after-tax account over to the Roth account. That would be the first way, the first plan that you would make those mega backdoor Roth contributions to. And then the individual would also have to have a side business, a side hustle, separate side self-employment activity with no full-time, non-owner, non-spouse employees working for their self-employed business. That would make them eligible to set up a solo 401k. And then they would have to open a solo 401k plan that supports mega backdoor Roth solo 401k contributions. So they'd have to open a solo 401k plan with a company like My Solo 401k Financial which offers a solo 401k that allows for mega backdoor Roth contributions. Specifically, it would have to be a plan like ours that allows for voluntary after-tax contributions and then in-service conversion of those voluntary after-tax solo 401k funds either to a Roth solo 401k or a Roth IRA. Now, it's noteworthy, and this is the key to be able to potentially get up to $140,000 across both plans for 2025. It's important to note that the voluntary after-tax contribution limit is not impacted by day job 401k contributions. So the voluntary after-tax contribution limit is the overall limit, also known as the 415C limit. And that is a reference to the section of the code, which is the basis for that limit. And that 415C limit, the overall limit, applies at the plan level. This is why when you have a 401k plan at a corporation, the business, the employer, doesn't have to ask the employees if they're making contributions to a 401k plan somewhere else, because the limit applies at the employer level, at the plan level. So the fact that this individual is making contributions to their day job 401k plan is not going to impact their ability to make voluntary after-tax contributions to their solo 401k. So as long as they have the income to justify $70,000 in voluntary after-tax contributions, so in other words, as long as they have the self-employment compensation to justify $70,000 in voluntary after-tax contributions, they can make a full $70,000 contribution for 2025 as an after-tax contribution to their solo 401k, and then move those monies, those after-tax funds, either to a Roth solo 401k or a Roth IRA. So let's talk about a quick example. Let's say someone has a day job 401k plan for 2025. They contribute up to the limit, $23,500 as an employee. Let's say that they also receive additional employer contributions. Could be a match, could be a profit sharing contribution equal to $6,500, bringing their total at that point to $30,000. So if their plan allows for voluntary after-tax contributions, like the Amazon plan, and they have the income and the capacity to make additional contributions, they could choose to make another $40,000 in voluntary after-tax contributions, bringing their total in contributions to their day job plan to $70,000. And then if that individual also has a separate self-employed business and they don't have any employees working for any company owned by that person or a spouse, if any, other than the spouse or that individual themselves, they could set up a solo 401k and then make voluntary after-tax contributions to that solo 401k. They could contribute 100% of their self-employment compensation up to that $70,000 limit as a voluntary after-tax contribution to the solo 401k, and then move those funds over to either to a Roth solo 401k or a Roth IRA. So that's, in short, how one could make $140,000 in mega backdoor Roth contributions, or contributions in sum, across both plans. Effectively, the ultimate mega backdoor Roth solo 401k strategy. All right, great. Well, hopefully that was helpful. If you're finding this video to be helpful, if you please like the video, share it with others that might find it interesting. Please like us on YouTube or LinkedIn or X. That'll help us get the word out to others just like you. And if you subscribe to our channels, whether on LinkedIn or YouTube or X, you'll get notifications of when we go live. We go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again for the afternoon session, which is what we're in the middle of now, at 1 p.m. Pacific, 4 p.m. Eastern. We like to bring content every single day, and then, of course, answer questions that folks might have, because we love to talk about questions or topics. So with that stated, let's go over a good question. Thank you so much for bringing it. All right, so I signed up for my solo 401k. It's been super easy and straightforward. Well, that's great. Thank you so much. We really appreciate the opportunity. Hoping you can provide some clarity for me when it comes to rolling over my previous solo 401k into my new solo 401k house with Titan Bank. I was told by my previous provider that they need a transfer form for my current custodian. But as I understand it, I am my own custodian trustee. So therefore, I would need to provide them with a transfer of assets letter or something similar. So number one, thank you so much. We appreciate it. Oh, and it sounds like somebody from the team already reached out that a letter of acceptance is being provided. That's exactly right. That's the process. So it looks like that's being handled. So thank you so much. But you've got another question here. Would it be possible to invest in crypto with both Roth and traditional funds, or is it best to keep the two types of funds separate? That's a great question. And the answer is yes. It's possible to invest in crypto with both traditional and Roth funds because our plan allows for both types of investments. Now, there's a couple of important considerations. Number one, when it comes to investing in crypto generally, it needs to be done via an account at a cryptocurrency exchange opened up under the name and EIN number of the plan. So for example, we've had folks open up accounts at Coinbase or Kraken or Gemini. And if you're going to be investing both types of funds, both Roth and pre-tax funds, then you would need to do that via two separate accounts at the cryptocurrency exchange. And then when it comes to funding that account, so those cryptocurrency exchanges, they want the funds to come from an external bank account where the name on the external bank account it matches the name on the account at the crypto exchange. So it would have to come from a bank account, for example, also opened up under the name and EIN number of the plan. And if it's going to be two separate types of funds, i.e. pre-tax and Roth, then that would need to come from two separate accounts. One account for pre-tax and a second account for Roth. So for example, you could roll over money to those accounts from another retirement account, like a former employer plan or a non-Roth IRA, or you could be making contributions to those bank accounts before the cash is transferred over to the account of the cryptocurrency exchange. Now, it's also noteworthy, one of our recent videos was talking about how Fidelity has rolled out the ability to invest in cryptocurrency via IRA accounts. So they don't, at the moment at least, support opening up accounts at Fidelity for a solo 401k to invest in crypto, but they've at least rolled out at this point the ability to invest in an IRA. So to the extent that you're eligible to transfer money to an IRA, then one could transfer money from their solo 401k to an IRA at Fidelity to invest in crypto. So for example, one scenario where someone's eligible to transfer to an IRA would be a mega backdoor Roth. So as we talked about in this presentation, our plan allows for making voluntary after-tax contributions. So when you make a voluntary after-tax solo 401k contribution, it needs to go to a separate voluntary after-tax account. Then you have the option to transfer those voluntary after-tax funds either to a Roth solo 401k or a Roth IRA. So for example, it would be possible to transfer from the voluntary after-tax solo 401k to a Roth IRA at Fidelity, and then from that Fidelity Roth IRA to one of their Fidelity Roth IRA crypto accounts that allows for direct investing in crypto. So that could be another path to be able to invest retirement money in crypto. Now that brings us to another point, which is that our AI is a great resource to answer questions quickly, etc. So for example, I want to show you, we've got the industry's first AI, which you can use for free at solo401k.ai. It's a great way to answer questions quickly and find resources. For example, we answered this question: can I invest both pre-tax or Roth in crypto, while we were on the phone? And it answered it in in an acceptable amount or in an acceptable manner. So we just highlight that as a resource to answer questions and find resources as I mentioned. So with that stated, let's move on to discuss another topic, which is the deadline to make contributions, which is a common source of questions this time of year. So in terms of the deadline, there are different factors to consider. One is, when was the plan set up? Two is, how is the self-employed business taxed? So for plans that were set up before the end of last year, so in other words, before December 31st or on or before December 31st, 2024, either with us, or if it was set up, say a basic plan somewhere else, but then upgraded to our plan here in 2025, that individual would have preserved the ability to make all types of contributions by their business tax return deadline, including extension. So that's where we get into the other factor, which is how the business is taxed. So if the plan was set up on or before the end of last year and a timely extension was filed for their self-employed business tax return, that individual can make all types of contributions for 2024 by that extended tax return deadline. So if their business is taxed as a sole proprietorship or an LLC taxed as a sole proprietorship, where the income reported on Schedule C of their 1040, and they filed that extension, a timely extension for their 1040, they can make contributions for 2024, all types, by October 15th of this year. Likewise, if their business is taxed as a partnership or an S Corp, and they filed an extension for their 1065 in the case of a partnership, or their 1120S in the case of a business taxed as an S Corp, and they set up the plan before the end of last year, either with us or with somewhere else, and then they upgrade to our plan, they can make all types of contributions for 2024 by their extended deadline. And finally, if the business is taxed as a C Corp and they filed an extension for their 2024 1120 in a timely manner, and they set up the plan either with us or somewhere else that's now been upgraded to our plan, they can make all types of contributions for 2024, whether employee, employer, or voluntary after tax, by that extended deadline for their business tax return. In other words, by October 15th, in the case of a business tax as a C Corp. But let's say the person didn't set up the plan until 2025, either with us or somewhere else that they're now upgrading to our plan. They could still make certain types of contributions for 2024, even though they didn't set up the plan until 2025, provided that they filed an extension for their 2024 business tax return deadline. So let's say their business is taxed as a sole prop, or an LLC taxed as a sole prop, with income reported on Schedule C of their 1040. If they filed an extension for their 1040 until October 15th, they could still set up a plan here in 2025 and make at least employer and or voluntary after-tax contributions for 2024 by that extended tax return deadline. Likewise, if the business is taxed as a partnership, where they file a 1065, or an S Corp, where they file an 1120S, and they filed a timely extension for their self-employed business tax return, they could still set up a plan here in 2025 and make at least employer and or voluntary after-tax contributions for 2024 by the extended tax return deadline. Finally, if the business is taxed as a C Corp, they didn't set up a plan here until 2025, but they filed an extension for their C Corp tax return for 2024 in a timely fashion, they could still set up a plan here in 2025 and make at least employer and or voluntary after-tax contributions. In other words, make a backdoor Roth contributions for 2024 by that extended deadline. All right, wonderful. And again, if you're finding this to be helpful, please like, please subscribe. Helps us to get the word out, and also you'll get notifications of when we go live. We also have our community with over 30,000 members. It's a vibrant community where people are posting questions. It's totally free to join. All are welcome. You can join quickly and easily at mysolo401k.net/my community. All right, next question. Do people people typically use QuickBooks, Google Sheets, or some other accounting software to track transactions in their solo 401k. What do you recommend if the solo 401k trustee will be invested in crypto and private lending? Not so much QuickBooks to track investments. I would say people are using Google Sheets or just an Excel spreadsheet to track their investments. Specific investment transactions are not reportable, right? When you just simply make an investment, sell an investment, that's not reportable by the plan. Now, once the value of the plan goes above $250,000, there's going to be an informational tax filing requirement called a Form 5500EZ, which we handle as an optional free service for our customers. Customers just have to let us know once the value exceeds $250,000 so we can prepare the 5500EZ. And at that point, at least the total value of the assets as of the end of the year will need to be reported. And we capture that information from the customer, and then we prepare the 5500EZ. We do it under the electronic filing system to make it easy for all parties. But it's still prudent, of course, to keep records of your investments. It's just not something that has to be proactively tracked, specific investment transactions. But yeah, just to answer your questions, I would say people are going to have a spreadsheet. Obviously, you're going to have statements, for each account into which those investments are made. For example, in the example we talked about up above, you're going to have bank account statements for the solo 401k bank account. You're going to have statements from the cryptocurrency exchange. It's good, of course, to keep records and hold on to those statements as part of the plan records. Hopefully that helps. Thank you so much for the good questions. We appreciate all the engagement. Please continue to engage. And thank you so much. Until next time, all the best.